Well, let's continue our conversation about decision day coming from the U.S. Fed and what it means to investors. We're joined now by Gary Schlossberg. He is a U.S. global strategist at Wells Fargo Investment Institute. Gary, thanks a lot for joining us. Let's begin briefly with what you will be watching for from the policy announcement from the Fed today, and perhaps more importantly, Jerome Powell's press conference.
Well, it's going to be a balancing act. The Fed chairman isn't going to want to say that the Fed is on the verge of easing up, given the employment data, the inflation data to come, the fact that inflation is still running well above the Fed's target. On the other hand, he doesn't want to give the impression that the Fed will continue to barrel ahead. He wants to give some indication that the Fed will be shifting gears in the size and pace of those rate hikes. So how he phrases that and how the market responds, I think, is really central to the market's performance today and going forward.
Okay, you remain cautious on the investing environment for stock market investors. You say this is not the time for investors to broadly buy equities. That sounds like a caution against buying the index, for instance, a big S&P 500 ETF.
Really focusing more on the liquid, high-quality defensive sectors of the market. That's where our favorable ratings are centered, with the exception of technology, just given the strategic opportunities. But basically, with a recession, we think, still lying ahead of us, even though it should be a moderate one, we think the worst of the earnings numbers still lie ahead. And we're not really sure that the market is fully discounted for that deterioration in earnings as we move through a recession. The market will rally before we're out of that recession. Stocks are a leading indicator, but we're just a little early for that.
And what is your take on earnings season thus far? I hear you saying that, if I understand correctly, you think next quarter's earnings will be weaker than the current quarter. What's your assessment of what we've heard so far in this reporting season?
Really mixed so far. Not only have some of the earnings come in short of expectations, but more importantly, the outlook on a growing number of firms has become more cautionary. And that's an indication that the visibility is beginning to deteriorate, much as we would expect as the economy's growth rate slowly winds down, culminating, we think, in a recession during the first half of the year.
Look, you also point to liquidity constraints in some notes that you've shared. You say liquidity constraints are becoming increasingly negative for stocks. Can you explain?
Yes, most of the stress indexes that we're looking at, not necessarily quality spreads fully, but the stress indexes, the growth in money supply declining now in real terms, and some of those other measures are tightening up. We're not at the point, we're not in a red zone, similar to where we were in 2008, 2020 by any means, not even 1998 during that short disruption that we had then. But increasingly, we think liquidity will be impinging on the market. It will have a more noticeable effect. That is the principal downside risk to the moderate recession we're forecasting. We don't expect to see a major liquidity disruption. But what we're seeing so far, we think, is a harbinger of more headwinds on the liquidity side as the Fed continues to raise rates.
So despite those reservations about the stock market environment, you have several. You say you continue to prefer U.S. equities over international stocks.
Yes, we think the U.S. is in better shape than those economies abroad. We'll all be going through a recession, with the possible exception of a very weak recovery in China. But just given the headwinds, the hurdles that Europe and some of the other more trade-oriented economies are facing now, we think that the U.S., at least through this cycle, will continue to outperform both emerging market and developed country stocks through the first half of next year.
And what about fixed income? What are your thoughts on the fixed income market right now?
Taking more of a barbelled approach. We have been favorable on the shorter dated securities, better insulated from rate increases, very short-term investments, of course, riding the increases in short-term interest rates propelled by the Fed. But increasingly, we feel we're getting close to that peak in longer-term interest rates, in bond yields. And for that reason, we're beginning to barbell our approach, focus more on those longer-term securities as well, just given their relatively attractive yields and the opportunity for gains once interest rates have peaked and begin to move lower. Intermediate securities, we're still negative on. They're most sensitive to what the market thinks the Fed will be doing, and we think that outlook will remain guarded.
What are your thoughts on, I'm just queuing it up on my screen here, the S&P 500 rally that we've seen since the early portion of October?
Well, of course, the market has come off in the past couple of days, perhaps a more sober view, caution ahead of the Fed, of course, but perhaps a more sober view of that interest rate outlook. But the economy did show signs of picking up speed. We think it was temporary, but we did have a pretty good third quarter for the economy. And of course, there was a period in the summer where we had one in a series of rallies on expectations that the Fed was approaching a pivot. And that turned out to be a little premature.
Patience, you think, will pay off for longer-term investors?
We do. Diversified portfolio tilted toward the higher quality investments, barbelled fixed income, perhaps dollar cost averaging for some of the longer-term investors. We think we're still entering a difficult period, but by the second half of next year, we're hopeful that we'll see that recovery, and the stock market will anticipate that.